Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for February 2018. Let's take a look at key highlights of January. Pre-budget economic survey predicted the economy is expected to rebound to 7.0 to 7.5% in 2018-2019, post-clocking 6.75% this year. Rising crude price, macroeconomic concerns and any setback to ongoing global recovery remain the key risks. Green shoots are visible in industrial recovery with an all-time high purchasing manager index at 54.7, 18-month high core industries growth, trend growth of 18% in commercial vehicle sales and 7% growth in Q2 manufacturing GDP. The government announced a recapitalization of Indian rupees 88,100 crore for 20 public sector banks in financial year 18, out of a total recap plan of Indian rupees 2.11 lakh crore announced in November 2017. The rally in commodity continues unabated as gold rallies to $1,330 per ounce and Brent crude hovers near the $70 per barrel. The US government was forced into a shutdown when the Senate failed to pass a resolution to temporarily fund the government. The impasse ended as the ruling Republicans agreed to opposition Democrats' demand for a debate on the contentious immigration policy. Nifty continued its upward march this month, breaking past the 11,000 level lead by earnings recovery, improving macros, strong global rally, and revival in FII inflows. One of the themes of the last 3 years has been the re-rating of Indian equities. Nifty EPS has grown at 7% CAGR from financial year 14 to financial year 18, while Nifty has appreciated by 12% CAGR, showing the optical re-rating for earnings multiple. In the short term, the index might have overshot and we may see a period of consolidation. But the primary trend remains bullish and we expect Nifty to touch 12,000 in financial year 19. Building India encompassing sectors like housing finance, cement, home building materials continues to be the broad theme which we favor. EPS estimates for Nifty index for financial year 18, financial year 19 and financial year 20 are Indian rupees 496, 621 and 740 respectively. As per blended estimates, index is currently trading at PE of approximately 18.5 times 1 year forward. We recommend investors to deploy 33% of fresh equity allocation, while the remaining can get invested over a 3 to 4 month period in a staggered manner. The new 10-year benchmark GSEC is hovering in the range of 7.20% to 7.45% on a semi-annualized basis. The yields have seen a jump on account of rise in inflation, spike in crude prices, and uptick in US Treasury yields. The CPI inflation at 5.2% year-on-year rose at its quickest pace in the last 17 months, predominantly due to the unseasonal rise in vegetable prices, high crude price, and unfavorable base effect. The trade deficit at $14.9 billion was the highest in the last 37 months as crude oil prices touched a 3-year high and gold imports rose by 73%, offsetting the positive impact of 12% export growth. Government of India has decided to reduce additional borrowing in financial year 17-18 to 20,000 crore from 50,000 crore. We expect a fiscal slippage of 0.2% for financial year 18 to 3.4% at the central level. We expect yields to trade in the range of 7.35% to 7.60%. Yield movement hereon will depend on inflation trajectory, crude oil price, upcoming union budget, adherence to fiscal deficit target, US Fed rate hike, and ECB's decision on tapering. We expect RBI MPC to maintain status quo in February policy review. We recommend investors to allocate 100% of their fresh fixed income allocation to long-dated buy and hold strategies and active accrual strategies with low to medium duration.